Now let's talk about labor volume variance. Well, actually, there are two variances that relate to volume. Look how come? Well, if we would spend budgeted amount of time for each and every operation, then we would get budgeted hours as that. But in fact, our workers worked not that efficient, and we spent more time, well, because for that the same unit of level of output, for how many units were produced, we spent more hours than we planned for. But the thing is that the nature of the agreement is that we cannot employ our workers for, let's say, 10 hours or 10.5 hours. We need to employ them for some longer time, like, let's say, for 40 hours a week, or let's say 160 hours a month, or half of the shift. So the amount, then the number of hours that we actually paid for the employees will be different. So when we want to calculate the effect of labor variances, we need to distinguish between two effects. Well, this effect, this is the fault of employees. This is because they worked not as efficient as they could have been. So the difference between the actual hours that was taken to produce the actual quantity of units of final production and between the budgeted hours, so the hours that would be required for this actual volume, but if we used budgeted efficiency, that is called efficiency variance. This is efficiency. And the difference between actual hours worked and actual hours paid, this is called idle time variance. Idle time variance means that the workers were just, I don't know, sitting on the bench, sitting in the office, drinking coffee and not doing any work. So this is more about like planning. So who planned hiring that many employees? Okay, so these are two different variances. And when we want to calculate that, so we are going to use the following formulas. Labor efficiency variance, so this first part, it's how much actual production did use. Actual production means that this actual quantity of units that we produced. And we will subtract actual production that should use, how many hours this actual production should use, and we will multiply that by standard rate. So meaning that actually actual production is actual quantity multiplied by actual efficiency. I will write it as AE. And from that, we will subtract actual production, so actual quantity multiplied by standard efficiency, and that is going to be multiplied by standard rate. This standard efficiency is just my abbreviation, so you will not see that in any resources, open resources. Idle time variance is when we take actual hours paid, and from that we subtract actual hours worked. So how much actual production did use, and we will multiply that by standard rate. We will multiply that by standard rate because it's a volume type of variance, a quantity type of variance, so we use standard rates. If you look at these two equations, we will see that these two parts, they cancel each other out when you add the first one with the second one to the second one. So what we get in the end is actual hours paid. So actual hours paid less actual quantity multiplied by standard efficiency multiplied by standard rate. So you will see that it looks like volume variance. And if you will add, it looks like as if it was a volume variance. So we do not calculate volume variance separately for labor. but you will see that it looks more or less like material volume variance, so the logics here is the same. And to make sure that you understand that, because I do know that the formulas and these words, they sound all the same, we are going to attempt an example question for you to practice. So let's see that. So the company's standard rate per hour is $10. However, the actual rate was 12. It has budgeted to spend 2,000 hours for product to produce 1,000 units. However, it spent 2,400 hours producing 1,100 units. Due to the nature of the agreement with employees, 25,000 hours were paid. We need to calculate labor variances. So let's calculate total labor variance. So total labor variance is going to be calculated as the amount that was actually paid. So we paid at the actual rate of $12, and we were supposed to pay 2,500 hours that were worked. And from that, we need to subtract the budgeted quantity. And the budgeted quantity is going to be calculated as, so we'll take the budgeted rate or standard rate in this question, multiplied by budgeted quantity. But we need to subtract the budgeted quantity that would be required to produce the actual output of 1,100 units. Okay, so look, we thought that we were going to spend 2,000 hours to produce 1,000 units. So this means that we thought that there is going to be 2 hours of labor per each and every unit produced. So that is how we make this calculation, and meaning that we have $8,000 of our total labor variance. So 8,000. Now let's break it into labor rate variance. And to calculate labor rate variance, we will need to take the actual rate less the actual rate is 12, sorry, less the budgeted rate of 10. And we will multiply that by actual hours. Okay, so we will need to take the actual hours that were paid. That is going to be 2,500. So this means that we have 5,000, and let's note which variance is favorable and which variance is adverse. We paid at higher rate that we expected, so it's adverse, and we paid more than we expected, and this is adverse as well. Now let's talk about labor efficiency. So labor efficiency is going to be calculated as standard rate, because it's type of volume variance, so that's 10, multiplied by how many hours were required, needed to produce actual units. So the company spent 2,400 hours producing the actual number of units. But how many hours were we supposed to spend? Oh, look, it's 1,100 units multiplied by, and our budgeted number of hours per unit was 2,000 divided by 1,000 equals 2. So we will multiply that by 2. Okay, so meaning that we had the variance that was it was adverse, so it's going to be 2,000 because we had to spend more hours than we expected, so it's adverse. But you know what? Well, actually, we're paid more than for 2,400 hours. So labor idle time, right, is going to be $10 because it's one of the examples of volume variance multiplied by actual number of hours paid less the amount that was needed to do the work. So minus 2,400. Oh, and what does it mean? It means that we have a variance of 1,000 and that is adverse. And look, if you sum everything up, you will get the adverse variance of 8,000, and this is the same that we got in the first equation. Well, that's because they always will add up to that. So total labor variance is the sum of labor rate variance, labor efficiency, and labor idle time. But we need to make sure that we take the right signs. So if, for example, one of them would be favorable, then the sign would be the opposite. Okay, so I hope you like this question, this example. The tricky part about labor variances is that you need to calculate these efficiencies. So taking the hours to produce and dividing by units. And if you are given not the hours and rate, but like actual expenditure and planned expenditure, like let's say $50,000, $48,000, then the approach is going to be the same. But you need to be alert to use the right efficiency, to use standard efficiency when you take the budgeted quantity. All right, and see you next.